Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Village Global's Venture Stories. I'm here today joined by three very special guests, my co-founder and Dwane, VP of Engineering at Twitter, Nick Caldwell, and partner at Better Tomorrow, Sheel Mohnot. We're lucky to have Sheel and Nick as network leaders at Village Global. Everybody, welcome to the podcast.
Thanks, man. Glad to be here.
Awesome. So we're excited to get into the craft of angel investing. How do people get started? How do they get better? First, I want to give a brief overview of why Village cares about this and spends so much time on it. At the highest level, we a lot of us like to make fun of VCs for sort of preaching one thing and then practicing something different. So they'll say, hey, no co-CEOs, you have to have one CEO, yet they'll have their partnerships, 7 people all equal. Or they will say, you need to have network effects or moats or scale. Don't run a lifestyle business, yet VCs often don't have any of those things. One other one that I find is interesting is that venture capitalists, as capitalists, are big fans of markets because markets, sort of decentralized markets, can better leverage networks and disperse information than a centrally planned, central planner determining what the price of the loaf of bread should be. You need to leverage a network. And yet, when it comes to their own investing practices, it's just 5 people on Sand Hill Road covering the entire ecosystem, every sector, every geo, every person, and believing that they can have perfect information in their heads on all of them. And so Village is structured really trying to decentralize that. Instead of 5 or 3 people, masters of the universe, we have dozens of angel investors that we co-invest with and even empower with our capital, and thus incentivize them to leverage their network expertise, their specific networks, their sector expertise, and make better decisions as a result. So we think a lot about who are the best angels, how to discover the best angels, and then how to help them get better as angels. Anne, is there anything you'd like to add to that?
No, that's a great summary. And, in general, I guess I'd say we look for people who are one of 2 categories. They're really early in identifying potential, the talent and opportunities hiding in plain sight, or they're experts. They're the kind of people that founders just really want to have on their cap table.
Yeah. Totally. And that's a perfect segue into Sheel and Nick, two people we've identified and worked with on a number of deals together. By way of introduction, Sheel, let's start with you. Why don't you talk about how you got into the practice of angel investing and then how you've what your journey has been evolving as an angel?
Yeah, sure. So I got into angel investing kind of maybe accidentally. I was a founder and I was pitching VCs and loved it. I love pitching, but I also instantly knew I want to be on the other side. I thought those people with VCs, they have all the money. They're so smart. They get to tell me what to do. These are thoughts I had at the time that I now know are crazy and stupid and wrong. And then when we sold the company in 2012, I had a little bit of capital and I had moved to San Francisco from Chicago. And so for me, angel investing accomplished a few different things. One, I had friends who were starting companies and I wanted to support them. 2, it was a way for me to candidly meet new people. I just moved to San Francisco and I was like, let me just put a shingle up there and meet people. And in fact, some of the people I invested in have become close friends. So that actually did work. And then I thought let me understand if I actually am better at this thing. I thought I was I thought I spotted trends early when I was an entrepreneur and there were companies I really wanted to invest in, but never did. And then, so I thought, let me see if I can spot those trends early. And then I thought also, let me see if I can be inspired by some company that I'm meeting, either join them on their journey or start something in an adjacent space. And then sort of finally, if I'm good at this, I'll make money. And, it accomplished all of those things. It's been truly remarkable. And so from that time, that was in 2012 until, until basically 2-3 years ago, I decided to become a real VC and up my game a little bit, and then now actually really formally up my game to a formal VC firm. I've enjoyed every bit of it.
Totally. How would you say you've applied all the learnings from your angel investing to your successful career as a reality star in The Zoom Bachelor?
I've learned it's all about like, I really want to get to know these people the same way I want to get to know these companies. And I treat the companies like I would treat any partner, right? Like I only work with people that I love working with. And I think the same applies in relationships.
Totally. The answer I would have given is timing is everything.
Timing is everything. That's also true.
Well, and could prospective dates or diligence you with portfolio companies? That could be really efficient.
Honestly, I think that's a good idea. I love being diligent. Actually, yeah.
You got nothing to hide?
I got nothing to hide. And actually, I was thinking like, especially in this new fund, we don't have a brand yet. So we have no brand, but we do have a reputation. And so in absence of brand, all we have is a reputation. So all we do all day long, our portfolio companies are like on the phone with potential portfolio companies of ours. And so that's what we have to do to kickstart it.
Awesome. Nick, how about you? Why don't you sort of detail your journey as an angel investor, how you got started and how it's evolved?
Okay, cool. I'm still pretty new to it, but I'm happy to tell you how I got to where I'm at. So I was at Microsoft for 15 years in Seattle and living in a world that had really nothing to do with angel investing. The scene in that part of the world is very, very different than what you see in the Bay Area. And, a couple of years ago, I moved down here to become VP of engineering at Reddit. It was my first sort of startup gig. And I was just sort of taken aback. I mean, the difference between the investing ecosystem in Seattle and what you see in San Francisco is night and day. That is to say, to live in San Francisco, and be in tech, you pretty much have to understand how these things work if you're going to function and network with other companies. So I was sort of immediately thrown into this world that I really didn't have any understanding of and felt the need to learn really quickly. So I started to meet with lots of different venture capital firms and understand how they think about the world. Eventually, I got introduced to the whole YC network, and I got to attend the first demo day. And that was really my first ham-fisted attempt at angel investing. So if you look at my portfolio, you can see most of the dead bodies came from that first YC meeting. But it was enough to give me a taste. And later on, I had attended a program called First Round Angel Track, which is a little bit more formal, has some great folks who come in and do talks. Lad Gill was one of them, really enjoyed that. And it gave a more formal structure for how to think about evaluating investments, so you're not just sort of treating it like gambling. I talked about forming the investment thesis and evaluating, which metrics and so forth. And since then, I've become, I would claim, a little bit more sophisticated in terms of how I think about my thesis and what I look for in founders and so forth. So I'm using angel investing, as Sheel said, to network. I think you learn so much from talking to founders who are immersed in a new area, not just because it's a cool area, but because they have to be immersed into it to survive. So I enjoy learning. I enjoy the networking. And then another aspect of it, in my particular career stage, I'm trying to do things that I think are meaningful. It's part of why I joined Twitter as VP of engineering, but also, as part of my angel investment thesis, I'm looking for underrepresented founders as well. And to me, it's been incredibly meaningful to, be first check to an underrepresented founder who's gone on to be successful. And I've done that twice now, amongst a large portfolio. So for me, it's learning. It's about being part of the whole Bay Area network, and then you can find some meaning in it too. I hope I make some money as well.
And what would you add in terms of advice that you give angels in how to get started or why they should do so?
Well, one is, I think a key to, and you heard it in both what Sheel and Nick were talking about, is relationships. Because Nick, I think the first deal we did together with Davaris Brown at Moraxa was based on a relationship you forged at Microsoft many years ago. And he had always heard of you and knew you, and now your worlds collided again. So I think that is really interesting, is just to think about keeping eyes and ears open.
Yeah, absolutely. I mean, it's the one thing I would call out as being critical to living and working in Silicon Valley. It's these relationships end up becoming more valuable than certainly the individual lines of code that you work on day to day. Your code is, if anything, like a depreciating asset, but the networks and the people that you meet appreciate over time. And Davaris, I met him first at Microsoft and then reconnected with him when he had also decided to move down to the Bay Area. And when he decided to go and do a raise, it was like, yeah, dude, I'll back you because of that longstanding relationship. He's since gone on to do quite well. I'm really proud of him.
I want to talk about the flip side of the relationships, which is regret minimization. If you have a friend who asks you to invest in them and you say no, and you're in a position to put in even a tiny bit of money to make the immensely successful, it will haunt you for the rest of your life. And that's what my sort of line on this is: invest in your friends' companies, except for your dumb friends, be their advisor. But if I passed on any friend listening, it's because I didn't have enough money at the time. And that's the only reason.
You get yourself in trouble.
I'm looking at, yeah. Everyone take a close look at all those companies that Erik is an advisor to.
Let's talk about onboarding to angel investing. One thing we're really excited about, so what we're all excited about is getting more people into angel investing. Nick, you sort of mentioned you started relatively late and perhaps might have liked to start earlier. And you mentioned how the first round program was very helpful for you. One thing Village and OnDeck are teaming up to create is this angel fellowship. And it's very much inspired by the success that the first round has had. And we sort of want to formalize it and create a wider sort of program. So we'll do cohorts of maybe 80 people, and we'll do maybe up to 10 a year. So we'll just be onboarding lots of different kinds of angels. What other advice do you have besides sort of, the goals of the program are to help, people find a network that they can co-invest with? Elad Gil, Keith Raboy, Mike Maples, Sarah Tavel, all these people, Reid Hoffman are coming to speak. So we have some expertise on how to think about portfolio construction, et cetera, and then some deal flow from the OnDeck Founder Network. What else would you advise, whether it's a mental shift or whether it's practical in terms of getting people started in angel investing? People who are listening to this saying, "Hey, I got some cash, but don't exactly know where to start." What other advice might you give to them? Either of you?
I think you should start by setting out a certain amount of money that you want to invest and think through how many investments you want to make. And I didn't do this, by the way, but one potentially good idea is to invest the same amount of money in every deal. $25,000. That's the check I write. That sort of thing. 25 or 50,000, whatever. And by the way, if it's not even that high, if it's not even $25,000, if it's $10,000 or maybe even $5,000, you could probably still slip into deals. Like, if you prove that you're helpful, companies will let you into their deals, and other investors like myself will make room for people who have proven that they can be valuable. And it doesn't necessarily matter what your check size is, but keep a consistent check size. Invest in a lot of companies. Like, the only way to get better is to practice, and the way you practice is making a lot of investments. You'll learn what you like. You'll learn what you don't like. You'll build some pattern recognition, which could be good, could be bad. But I think in general, just do a lot of it. When I was getting started, so over the course of like 4 or 5 years, I did about 30 investments as an angel. And that pace is high for some people, but like, to have success, you typically need to have a lot of numbers. And so the other thing you'll have to realize is it does take time. Like, people ask your time. And for me, what I found is I loved giving the time, actually. Like, I really enjoyed helping founders at the earliest stages. And that's actually a great joy for me. And that's actually why I decided to become a full-time investor. Is I loved helping so much that I thought, like, I should be able to do this with more money than I have. I should use other people's money. And that's what I've been doing more recently.
Yeah. To indicate to the audience who can't see Sheel's commitment to this, he's wearing a Patagonia jacket right now.
Damn it.
As we speak. Two things I'd add to that. One is, do a lot and start early, because it takes a lot of years to get feedback on how you're doing. And VC is often reflexive, where the people who are known as the best have done the best deals and then get even better deals and then become better. And the only get known as the best, or the easiest way to get known as the best, is to have winners. And the way to have winners is to start early, such that you can, have 5 years pass to have a couple big companies. And I think people don't fully appreciate just how long the feedback cycle is relative to other fields or other practices. The other thing I'd say is it's important to consider scout money for people who can't afford it. And the way I would think about scout money is adding so much value to venture capitalists that they can't ignore you, basically. Just keep sending them deals, and don't necessarily think, on the first one, they have to compensate you for it. But if you keep sending them deals and they do one or they do two, at some point, they're going to be like, hey, I should just cut out the middleman and just give you an allocation. You should do it. Too many people, I think, try to be transactional in the first check, or just say, hey, I'm ready to be a scout, make me a scout, where it's really the people who've been putting in the work for quite some time, who built a relationship such that they'll trust them with an allocation. And that's how I got started at Product Hunt. I was lucky to have that tool to just send deals to people all the time. And then without even asking, someone was like, hey, let's just cut me out. Here's just a pool. Why don't you just go invest it?
Building on that, Erik, I think sometimes people, they should maybe hang out in the tidal pools of entrepreneurship and try to pick their first deals. An alternative is to take your skills and go to another angel or go to a VC and say, I know something about growth. I know how to go to market in these situations. I'd love to help some of your portfolio companies. And you can demonstrate some of your value, both to founders and to the VCs, which might lead to a scout allocation. Plus, when you're working with the VCs, you'll naturally get some deal flow. So it's kind of circular.
And you stole one of my tips I was going to give. But no, I think you're totally right, though. It's I made this mistake early on when I was trying to explore different ways to get deal flow. So my first attempt was I have a decently sized social media following, so I decided to go that route and see how far I could get attracting deal flow. And turns out that was a disastrous mistake. I got flooded with really bad ideas. I think if I were running my own firm, I might have the capacity to have vetted all of those, but it did not go how I'd anticipated. And then over the last year, what I found is that it's been the relationships with VCs and other entrepreneurs that have actually bought the best deals, because they know what I'm actually interested in. So I'm not being flooded with like direct to consumer things, or, hey, do you want to start a jewelry shop in Eastern Africa? It's things that I actually know and can help with. And I think that would lead to the second point I would make, which is when I got started, I definitely hadn't thought through a thesis or set of things I really cared about. And so people didn't really know how to interface with me. Like they read my resume and take a few guesses on things that I, based on that I was interested in. But I found that like when I just sat down and wrote even just 2 paragraphs and posted it up on my LinkedIn profile about what I actually care about, the quality of deals and asks coming my way went up substantially. So just thinking through like your hypothesis and where you think the world's going can be a great filter. And the final thing, I think Sheel said this earlier, but I wanted to tack onto it. Showing value. I found that the bar as an angel to show value is pretty low. So like I've just learned this over time. Like when I talk to founders, like I'll always tell them, look, like every month when you send out your update, I'll respond in some way, even if it's only to say congratulations on the progress. But if I see something I can help in your investor asks, I'll take a swing at it. And just committing to doing that has been like put me above the bar for most founders. And then they go on to refer me to other great companies. So just, carve out, even 15 minutes a month to do some responses has been really helpful for me.
Yeah. I think that's so true. The bar is very low. One of the things that I found as I transitioned from an angel to an investor that didn't lead rounds to now an investor that leads rounds is how critical that is, just being so helpful. So if you ever want to make the transition to leading rounds, know that it's about winning. And there's typically only one or sometimes two leads per round. And a lot of these companies in this market, a good company has 5+ term sheets sometimes. So, they're calling all of your references. So like all of the goodwill that you built during that time as an angel investor, it's like time to cash it in right now. And I'm using all of my relationships with entrepreneurs over the past several years to like get on the phone with people who don't know my firm and say, you got to work with this guy, and like start that early and be the most helpful angel you can, and it'll pay dividends for you in the future.
Totally. I want to segue into the evaluation period. How we think about evaluating founders. What do you look for in founders or strong founding teams, or what questions? What are your favorite questions to ask founders to better suss out whether you might like to invest? Sheel, any starting with you, any frameworks that you like to think about?
Yeah, I think about, I don't have any good specific questions, but I think about, broadly speaking, is this person, have they clearly articulated their vision to me? And for me, like if somebody can clearly articulate their vision and get me to buy into that vision, that's the most important thing. So it's like, do they have some domain knowledge and expertise and that they can show me? It doesn't have to be prior domain knowledge or expertise, but like, have they learned enough that they can teach me something? And do I believe that they can execute on their plan? And then it's not just one person, but the CEO tends to be who I spend the most time with. So that's like the most important thing. And if they're not clear and authentic, I don't think they're not going to be able to sell me. They're not going to be able to sell customers. They're not going to be able to sell future investors. And then they're not going to be able to sell future employees to join them. And so that's the most critical thing. And then it's also like, we invest in companies that we think can become billion-dollar plus companies. And so is this somebody who I think can lead a 200-person organization?
Nick, how do you think about that?
I mean, I would say maybe there's two ways I would break it down. Like I have a couple consumer products and I primarily do enterprise. On consumer, I pretty much am like, is this guy in Gen Z or this guy or gal a Gen Z person? And do I roughly like their idea? That's the entirety of it, because I can't predict anything in that space. For enterprise, though, I know quite a bit about that space. So I look at the biggest mistake with founders I see working on enterprise is they'll be a little too focused on the tech and they don't think through the go-to-market. So I look at if the founder has that balance, like they've thought through this problem on multiple dimensions. It's not just like, oh, I have some cool new database technology, but I've actually spent time trying to land a mid-market or enterprise sales. Like, do I believe this person actually has the capability to build the constellation of disciplines that are required to take a product fully to market? And that can come out pretty quickly. I mean, you can see if people either have sales experience or maybe if one of the first activities they've done as a founder is spend time with a customer and do some journey mapping or design cycle or whatever process they might want. But like, I look for that balance that goes, beyond having a great technical chops to thinking in a multidiscipline fashion. The other thing that I get hit with a lot is people who haven't really thought through the scale. So they might have a really good idea and understand how to go to market, but they don't realize that what they're proposing is maybe just a service business or it'll never get out of SMB. So I really pressure people to think through, if things go well, how does your business actually get to 100 million ARR? Do you realistically have an answer for that? That actually weeds out quite a few people because they've never been in a situation to have to think through that. Beyond that, there's also kind of honestly with any thing where it's an investment and people are taking money out of my pocket, there's a social component to it too. So, do I imagine myself having a good relationship with this person? And that can come it's hard to measure, but it matters. Like you want to believe that your money's going to find a good home, not just in terms of the business, but with the person that you're giving it to. And that can come out in different ways, but those are the dimensions I look at.
Totally. And Nick, say more to what extent you're sort of founder driven versus thesis driven or market driven. And maybe you could use Dwane at Moraxa as an example for sort of your thought process making an investment.
Yeah, sure. I mean, so it's an intersection of two things. Like I have a thesis, and if your company doesn't kind of match to one of the things that I'm interested in, hyper collaboration, the future of no ops, the future of online education. These are roughly the three things I care about. And if you don't map within that thesis, I kind of politely filter you out right away. So Dwane is in the realm of moving toward no ops. Like he's come up with an idea that massively simplifies the deployment and operationalization of real-time data streams, which is an emerging problem that I, through my own experience as an operator at Looker and other places, know increasingly matters. So he's landed the sort of thesis aspect of it, and then on that personal basis, I've known that guy for four years now, and day one I met him, he was pitching me on some hustle. Like I know he's got, I know he's got like the founder hunger. And when you find people like that who have that energy and they're just looking for like the right product to apply that energy, the potential's there. And when he started talking to me about Moraxa, I could see great founder energy lining up with an idea that is primed, bleeding edge, market ready. And I took the first opportunity I could to cut that check.
And what advice do you often dispense to angels in terms of, or what questions do you like to ask founders, or how do you think about evaluating the founder portion of it?
Got it. Well, so often I feel like we see little snapshots, and I'm more interested in helping the founder help me envision the movie, like see the movie. What have you done, and what have you learned as a result? Especially, Erik, because we fund so many first-time founders. And we're trying to gauge potential. And maybe they haven't built a business before, but talking through things like, how did you make that decision? And maybe it was a decision to start something else or leave something else, but just what is their thought process? And then my favorite thought about founders is entrepreneurs don't see a different world. They just see the opportunity in the world. It's kind of like comedians don't see a different world, but they see the humor in the world. So can they find that insight? And then my final word I would say is resourceful. And resourceful is a funny word because it's what you are when you don't have resources. And like, can you figure stuff out? Because even when founders are well funded, you're never funded as big as an incumbent, right? And you never have enough time or resources. So you got to make choices to figure it out.
Totally. And a couple of things I like to think about are, I think the term social proof has gotten sort of, people sort of use it to mean like who else is investing. Whereas I often don't find that to be a ton of signal, unless what I really find to be signal is people who've known that person for a long time and have a lot of data on that team, being able to give insight for when you're just being an entrepreneur. So if some even a prestigious investor just comes in and meets them for the first time or pretty recently, I don't think a ton about that. But if it's, hey, they've gotten backing from every CEO they've ever worked with, that's pretty meaningful to me. So I like to go, especially when you're meeting someone, you're trying to get as much data as you can in a short period of time, really referencing with people who've worked with them in the past, who've known them for a long time. And one sort of cheat code we like to use here is the On Deck Founder Fellowship, which enables us to meet people, 6 months before they even start a company and start to build that relationship and track them, week after week, sort of. And talks about like the say versus do ratio. How much are they talking versus how much are they executing or shipping or building. So that's definitely something I think about as well. Okay, so we talked about how to evaluate team. What other frameworks do we have for just evaluating investments more generally? Sheel, let's start with you.
Yeah, so I have a T framework that I like to use. I didn't invent it. It's just something I heard somewhere. So it starts with team. Team is number one, the most important thing at seed in particular. Number two, TAM, total addressable market. Like, is there a market opportunity here? Is it big enough? Are there market shifts and opportunities that make it now the time, or TAM/trends? Traction, by the way, does not have to mean revenue. A lot of people think that that's what it means, but actually especially where I invest in fintech, oftentimes there's no revenue. It's really like, have you sorted through certain things? Do I think you'll be able to sort through many more things? Have you done some customer validation, all that sort of stuff? Technology, is there something new and compelling about what you're doing? And do you have a technology team that I think will be able to execute on it? Terms, like, is this a reasonable deal? Like, do I think that you're in the realm of reasonable? And for me, and actually we should quick side note on that, sort of like where we think deals are reasonable. So from my standpoint, there's now bifurcated seed into pre-seed and seed. And I would say seed rounds that we've invested at, or pre-seed rounds that we've invested at, are like between a $4 and $8 million valuation, maybe up to 10. And then seed rounds in the 10 to 15 range now. And these are for like Bay Area rounds, different elsewhere in the world. So again, the T's: team, TAM, tech, traction, terms. And then there's the sixth T, which is totally random. And those are like, that's the like, do I really like this person? Especially now as a lead investor, I'm going to be in business with this person for 5 to 10 years. Do I want to be stuck with this person? Is it great to be stuck with this person? So, there's a random questions that I ask there.
One thing I've noticed also transitioning from an angel investor to a fund manager, you were talking about terms, is as an angel, managing, or a scout managing $1 million or $2 million, you could invest at, 30 million post, or you could invest at higher valuations and still get an outcome that could return the whole fund. Obviously, it's $1 million, $2 million, or and you could also write smaller checks and just squeeze in. So you could be sort of last investor in. So I sort of found that I was like chasing hotness in a way that when you become a fund manager and you start managing a lot of money, you can't invest on those terms because the outcome has to be so big, or such that it could return the fund. And then also you have to deploy much more capital, so you can't be last check in. You have to be first check in. And so just that changes the whole dynamic of how you think about investing.
Yeah. And I think a lot of angels, like as an angel, you're a price taker. You're not setting the price. So I think a lot of angels are pretty agnostic to price. And that's a totally fine way to be, depending on what your rationale for becoming an angel investor are, like we talked about.
Yeah.
Like some people just want to be in the hot deals, and that's also fine.
Yeah. Going back to what we were talking about, the long feedback loops, if you found LeBron James at 20 years old, you could get a sense that he is amazing at 20 years old and that he will be amazing, 5 years from now, 10 years from now. But it doesn't, like the venture investor at, someone can be well networked or even smart, but you can't really know if they're any good in terms of will the returns be good. And you also don't know if people get better over time. It's kind of hard to assess. How do you guys think about your own practice? Are you getting better? How do you have a sense about it? And how do you think about your own growth in that way?
I mean, I might have a totally different angle. I'm pretty new at angel investing, and I think that I hope to someday measure my success by the amount of return. But the reality is I'm presently measuring my value by the number of underrepresented founders I can find and fund. Like that's the meaning I'm getting out of this at my stage. And, I want to see those folks be successful, and that's the high order mission. And hopefully that'll return some money as well. But like, I really want to see more underrepresented startup execs out there in the world. And then hopefully they'll turn around and do the same when they can.
Awesome. It's interesting because I think that it's how do you develop a scorecard for yourself around either the values that you have, like Nick was talking about, or the process. Like I want to be supporting certain founders or have a high level of standards such that the founders are referring me to other people. And I think every day, if you run a good process, good habits, hopefully that's rewarded, right? Because there is a lot of serendipity in what we do, but hopefully consistency is better than intensity in terms of delivering outcomes over the long term.
There's so much luck involved.
so much luck involved.
And that's why VCs are bullshitters.
Well, so, my favorite story about luck is that there's a guy, a researcher, and he ran an experiment with college students where he said, hey, I need you to come in and read this newspaper. And if you count all the pictures that are in the newspaper and you bring it up here to that head of the class, I will pay you $100. And so he hands out the newspapers to all the students. And in about 2 or 3 minutes, a few of the students are going right up to the desk and handing in the newspaper with their little scorecard. And the rest are, diligently counting. And the result of the study afterwards, the professor had put on page 2 of the newspaper in huge type, you don't need to count the pictures. Just walk up and say the number 39 to me. But it was in text. And the very diligent people who were counting pictures all missed it. But people who, and this is interesting, people who considered themselves lucky were more opportunistic, more likely to read the text. So maybe there's something to more than luck.
Yeah, perceiving your own luck or creating your own luck. Yeah, it's super interesting. We think a lot about how to pick angel investors, and so we often use Chris Sacca as an example. Some of his first investments were Uber and Twitter at let's say at age 30. At 40, is he better than he was at 30? So how do you catch people who are sort of on the up and up, but aren't so advanced that they're like now raising their own $300 million funds? And so it's just very interesting sort of philosophical
yeah.
of how to assess good angel investing and what's the right timing.
I don't know. My take as an early person in this is that the success kind of breeds itself. I've had a couple that have gone well, and they immediately resulted, because your name's on the cap table, and getting better opportunities. So I think you get a couple winners, and then you kind of you're in the know somewhat artificially, I think.
The other thing on that note that I feel like no one ever talks about, but it's clearly true, is people only remember your winners. So if you're in every deal, you're only talking about the ones that you won. It doesn't matter that you did 100 investments that year. There were 3 that were great. Like that's what your reputation somehow has become. So so a lot of people, they're just in every deal, and that actually works. Depending on what your goals are, that actually works. Like you were in the hot deals, you were in the good, and that can work out financially too. But that's how some people play it.
Totally. Yeah, what Sheel is saying is invest in all your friends, and the ones that don't work out, just never talk about them, never talk to them. just ignore them. But the ones who really made it, talk about how you were there from day one.
Yeah.
You were a founding investor. I think this is a perfect place to wrap. Sheel, Nick, for people who want to reach out to you and potentially pitch you, what might you say about things that you're looking for, or best ways to potentially get in touch with you or your fund in the case of you, Sheel? Sheel, why don't you start off?
Yeah, actually, I've recently gotten a bunch of pitches on Twitter, and happy to take those. Easy to find. And so because this episode's geared towards angel investors, I'd also say look, if you're getting started and especially if you're interested in fintech, hit me up. I'm happy to share stuff. There are oftentimes we're leading rounds and have opportunities for other people to get involved. And if you let me know what you're interested in, hopefully we'll work together someday. Nick,
how about you?
Yeah, likewise, I highly recommend connecting with me on Twitter at Nick Cald. Also have a website where you can kind of see my investment thesis. Just go to nickcaldwell.com. And, I'm primarily, looking at data and data-related startups. I also think that hyper collaboration, the idea that all productivity tools are going to be built with teams in mind, is something that excites me. So, if you're interested in any of that, don't be shy. Just hit me up on my website or on Twitter.
Awesome. Ann and I are excited to take any sort of pitches as it relates to being a network leader at Village Global and or joining the On Deck Angel Fellowship in partnership with Village. And we're excited to have Sheel and Nick both as network leaders and in the fellowship, respectively. Ann, Nick, Sheel, thanks for coming to the podcast. It's been a great episode.
Thanks.
Thanks, Erik.
Thanks.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.